Hi, Professor Morgan-Nance here with a short video about Treasury stock. When a corporation repurchases shares of its own stock, it's called Treasury stock. Now, why might a corporation want to buy back its own stock? Reasons include 1. To use their shares to acquire another corporation, 2. To purchase shares to avoid a hostile takeover of the company, 3. To reissue them to employees as compensation, and 4. Finally, to maintain a strong market for their stock or to show management's confidence in the current stock price. A corporation's treasury stock is similar to unissued stock in several ways. First, treasury stock is not an asset. Second, it does not receive cash dividends or stock dividends. And finally, it does not have voting rights. However, treasury stock does differ from unissued stock in one major way. The corporation can resell treasury stock to generate additional capital. Now, this is especially good if the market value of the stock has increased above the repurchase price. Let's see how a purchase of treasury stock would be recorded. On May 1st, Cyber Incorporated purchased 1,000 of its own shares in the market for $11.50 per share. The entry on May 1st includes a debit to treasury stock and a credit to cash for $11,500, which is the amount of the purchase. To repeat a previous point, it's important to note that when we purchase our own stock, it is not an asset. Instinct makes us want to call it an asset, however, it is not. The Treasury stock account, which is a contra equity account, is reported on the balance sheet in the stockholders' equity section as a reduction from total stockholders' equity. Now, let's see what happens when the Treasury stock is resold. We'll have a couple examples here. When we sell some treasury stock, do we have a gain or a loss to record? No. Again, instinct does not prevail. Let's have a look. If treasury stock is reissued at cost, the entry is just the reverse of the one made to record the purchase. For instance, if on May 21st, Cyber reissues 100 of its treasury shares purchased on May 1st at the same price of $11.50, we debit cash and credit treasury stock for $1,150. This is a nice clean entry because we sold the treasury stock for its original cost of $11.50 per share. If, however, treasury stock is sold for more than cost, the amount received in excess of cost is credited to the paid-in capital treasury stock account. This account is reported as a separate item in the stockholders' equity section. No gain is ever reported from the sale of treasury stock. To illustrate, if Cyber receives $12 per share for 400 treasury shares costing $11.50 per share on June 3rd, the entry would be to debit cash for $4,800, the amount received. A credit to treasury stock for $4,600 would be recorded as well. This amount is the original cost of $11.50 per share times the 400 shares sold. The difference between the selling price and the cost of the stock is credited to paid-in capital treasury stock. In this example, that amount is $200. Now let's see what happens if we sell treasury stock for less than its original cost. When treasury stock is sold below cost, the entry to record the sale becomes a little trickier. It depends on whether the paid-in capital treasury stock account has a credit balance or not. If it has a zero balance, the excess of cost over the sales price is debited to retained earnings. If the paid-in capital treasury stock account has a credit balance, though, it is debited for the excess of the cost over the selling price, but not to exceed the balance in this account. When the credit balance in this paid-in capital account is eliminated, any remaining difference between the cost and the selling price is then debited to retained earnings. To illustrate, Cyber sells its remaining 500 shares of treasury stock at $10 per share on July 10. Remember, the original cost of the treasury stock was $11.50 per share. The entry would include a debit to cash for the proceeds of $5,000. A credit to treasury stock of $5,750 would be recorded for the original cost of the stock times the 500 shares sold. And the difference between the selling price and the cost of the treasury stock is a reduction in equity of $7.50, as shown in this entry. That's 500 shares times $1.50 per share, excess cost over selling price. In this case, we first zero out the paid-in capital on treasury stock that we originally recorded of $200 with a debit. The remaining $5.50 debit is recorded to retained earnings. And one more point. I mentioned earlier about the number of shares of stock authorized, issued, and outstanding. The number of shares outstanding means the number of shares issued or sold minus the number of shares purchased back as treasury stock. In short, outstanding shares equal issued shares minus treasury shares. Dividends are paid on the number of shares outstanding, but not on the treasury stock. I hope this makes sense. And this concludes our discussion about treasury stock.